Fintech Disruptors, from PayPal Mafia to Stripe, turning code into cash flow. Palo Alto, late 1990s. The internet is still slow and ugly. Web pages look like brochures built out of broken tables and bad fonts. .com is both a punchline and a gold rush, and nobody is quite sure whether the whole thing is the future or a very expensive prank. In a bland office above a street you've never heard of, a small team is wrestling with a question that sounds almost naive. Why is it so hard to send money online? Email moves instantly. Photos can be attached, even if they load line by line. You can chat with strangers in other countries, and yet, if you want to pay someone, you're still stuck in a world of checks, bank transfers that take days, and card payments that feel like a bureaucratical ritual. The security people are nervous. The banks are skeptical. The fraudsters, meanwhile, are delighted. The company is called PayPal. It will eventually be worth billions, but the most important thing it creates might not be its product. It might be the pattern it proves. That if you can turn financial plumbing into software, you can turn software into cash flow. PayPal is not born as a clean idea. It's more like a collision. On one side, you have Max Levchin and his crew, obsessed with cryptography and the gritty details of keeping transactions secure in a world where anonymity is easy and accountability is hard. On another side, you have Peter Thiel, thinking in big abstractions about competition, modes, and how to build a company that doesn't get commoditized immediately. And then you have Elon Musk's X.com, a rival with its own ambition. An everything finance app before the world even has the bandwidth to imagine one. These pieces merge, and the result is a strange organism that has to survive in real time. Because their problem isn't simply build a payments button. Their problem is, how do you let two strangers on the internet exchange value without being robbed, reversed, or regulated into oblivion? Inside PayPal, people are pulling 14-hour days trying to do three things at once. Keep fraud under control, keep the servers alive, convince online sellers, especially on eBay, that getting paid through this weird service is safer than waiting for a check in the email. And here's what makes it interesting technically. Payments are not just software. They are adversarial software. If you build a photo sharing site, the worst case is someone uploads a blurry cat picture. If you build a payment system, the worst case is someone actively tries to break it over and over because the prize is money. Fraud isn't a side issue, it is the main product risk. PayPal has to build systems to detect patterns that look like abuse. Many accounts created from the same IP range, suspicious velocity of transactions, mismatched names, unusual chargeback rates, stolen cards being tested with tiny purchases. They are essentially doing early applied machine learning and anomaly detection before machine learning becomes a mainstream phrase, and they are doing it under fire. At the same time, they are fighting on another front, the card networks and banks. PayPal still has to connect to the existing rails. That means living inside the rules of Visa and MasterCard, inside the constraints of bank accounts and ACH transfers. It means dealing with risk teams, compliance checklists, and the fact that chargebacks exist. A credit card payments can be reversed, and when it is, someone has to eat the loss. PayPal is building a layer of trust on top of a system that was not designed for strangers meeting in a digital bazaar. And in the late 1990s, when eBay explodes as a marketplace, that layer suddenly matters. If you want to buy a camera from a person you've never met in another state, PayPal turns that exchange from risky and slow into possible and fast. The user base surges. The firm goes public. Then eBay buys it. The story could end here, but it doesn't, because PayPal accidentally becomes something like a training program for an entire generation of builders. People learn at close range what money looks like when it is treated as a software problem. What people later call the PayPal Mafia is really a dense web of alumni who keep working together, investing in each other, hiring each other, and carrying the same instincts into new companies. They have shared scar tissue. They remember fraud spikes at 3 a.m. They remember watching conversion rates fall because the sign-up flow had one extra field. They remember how a payment that takes 2 days feels like a century online. They remember that banks are not evil, just slow, and that you can either fight that slowness or wrap it. Most importantly, they internalize one deep idea that becomes almost a Silicon Valley religion. Money is just data with rules. If you can store data, move data, encrypt data, and verify data, then at some level you can store, move, encrypt, and verify money. The catch is that money's rules are brutal. Regulation, fraud, chargebacks, identity verifications, sanctions lists, anti-money laundering checks, consumer protection. So the game is not to pretend those rules don't exist. The game is to build software that makes living with those rules feel effortless for the user. This is where fintech's real innovation often lives. Not in inventing money, in compressing complexity. And once you start looking for it, you will see the pattern everywhere. In the 2000s, if you are a small business and you want to accept card payments online, it's not a matter of adding a button. You need a merchant account. That means underwriting, paperwork, business verification, and sometimes rolling reserves. Your risk profile is assessed because the bank is effectively extending you a kind of credit. If you get chargebacks, the system wants to know someone can pay. Then there's the payment gateway, the technical layer that routes card data and authorization requests. There are PCI compliance requirements, meaning if you touch a card number, you inherit security obligations. There are fraud tools, dispute management, reconciliation, settlement schedules, interchange fees. None of this feels like the internet. It feels like a museum exhibit labeled How Commerce Used to Work. Developers hate it. And into that frustration walks a new company with a blunt pitch. Two brothers from Ireland, Patrick and John Collison, want to let you accept payments online in a few lines of code. The company is called Stripe. Stripe's genius is not that it invents card payments. The card networks are still there. The banks are still there. The same interchange system still hums in the background. Stripe's genius is that it packages the mess into an API that engineers can use without learning the entire history of banking. Instead of making you integrate a clunky gateway with a PDF manual, Stripe gives you clean documentation, sensible error messages, developer-friendly dashboards, and onboarding that feels like signing up for a new software tool instead of pleading with a bank. The technical trick is partly architecture and partly product philosophy. They handle tokenization so card data is not constantly exposed. They build risk scoring and fraud detection at platform level using network effects. If Stripe sees patterns of fraud across thousands of merchants, it can improve defenses for everyone. They invest in reliability, because downtime in payments is existential. A store that can't charge is a store that is closed. They also make global commerce easier, dealing with currency conversion, local payment methods, and region-specific compliance so the merchant doesn't have to. Over time, Stripe becomes not just accept cards, but run an internet business infrastructure. Subscriptions, invoicing, marketplace payouts, identity verification, and tax calculation. It looks simple because the hard parts are hidden. That, in modern finance, is power. While Stripe rewrites the web interface, another shift is happening in your pocket. Phones change from devices you call with into devices you live in. Always connected, always within reach. Capable of being a wallet, a bank branch, and a financial assistant in one rectangle of glass. Once that happens, the old rituals of banking start to look strange. Why do you need to visit a branch to open an account? Why do transfers feel slow when you can send a video instantly? Why are overdraft fees and delayed posting still treated as normal? Mobile wallets and peer-to-peer apps bloom. In the US, Venmo and Cash App turn payments into social messages, emojis, captions, instant splits. In China, Alipay and WeChat Pay embed payments into super apps where scanning a QR code becomes as natural as breathing. In parts of Africa, M-Pesa shows that you don't even need a smartphone to build a payment network. You need a simple interface, trusted agents, and a system people can access reliably. Neobanks emerge as a similar interface play. No branches, clean design, instant notifications, tighter control over spending categories, fewer obvious fees. Often, the underlying deposits still sit in licensed partner banks. The regulated core remains, but the user relationship changes. And in finance, the relationship is everything. If your daily money experience lives inside a Fintech app, you start to trust the app more than the institution behind it, even if that institution is the one holding your insured deposits. That is not just branding, it is a reallocation of power. Because whoever owns the interface can cross-sell, gather data, shape behavior, and decide what the next product is. Payments are only the first act. Once you have an interface people trust, you can offer the next layers, borrowing and investing. Online lenders promise to speed up credit decisions using data and automation. Sometimes they use alternative signals like cashflow patterns in bank accounts, invoice histories, or business performance metrics rather than just credit scores. Sometimes they land on their own balance sheet. Sometimes they originate loans and sell them to institutions, turning credit into a pipeline product. Robo-advisors take the logic of index investing and wrap it in a user experience. A questionnaire, a portfolio of ETFs, automatic rebalancing, tax loss harvesting in some cases, and fees lower than traditional wealth managers. The innovation is not investing theory, which already existed. It is distribution and ease. Buy now, pay later slips between credit and checkout. The user sees 4 payments off and feels no friction, no card interest rate, no obvious loan. Under the hood, the company is managing credit risk, merchant fees, and funding costs. It is doing banking, but disguised as convenience. And the business model repeats. Look at something expensive and slow in traditional finance. Wrap it in better UX, automate the paperwork, reduce visible friction, take a thin slice of every flow. A small percentage of enormous volume becomes a river. Fintech is often pitched as revolution, but in practice it is usually rewiring. Most fintech firms are not allowed to do everything a bank does. They don't create money the way banks do. They don't have direct access to central bank reserves unless they are a regulated bank. They often rely on partner banks for deposit accounts and on card networks and ACH rails for movement of funds. That means the move fast and break things ethos hits hard boundaries. Money is one of the most regulated parts of modern life for a reason. It can be used for fraud, money laundering, sanctions evasion, and systemic abuse. So fintech companies have to become good at compliance even if they don't advertise it. KYC, Know Your Customer, means identity verification, document checks, fraud screening. AML, Anti-Money Laundering, means monitoring transaction patterns, flagging suspicious flows, filing reports. If you operate cross-border, you deal with sanctions lists and jurisdictional rules. If you lend, you deal with customer protection laws and the ugly reality that defaults are not a bug, they are a feature of credit. The strong fintechs don't pretend these things disappear. They build them into the product so that the user feels smoothness while the system quietly enforces rules. And when it goes wrong, you see why this is hard. Neobanks struggle to become profitable without fees they mocked. Online lenders learn that risk models look brilliant in calm years and suddenly humble in recession. Buy now, pay later can create debt layering when consumers stack too many installments plans. Payment companies still fight fraud forever because fraud adapts. Even so, the consumer expectation has permanently changed. People are no longer impressed that they can bank online. They are annoyed when they can't. The bar has moved. And once expectations move, the old system has to adapt because user behavior is a kind of pressure that even large institutions can't ignore. There is a reason this story has a slightful hope arc. When payments and banking become software, the system can improve faster. Bugs get fixed, interfaces get redesigned, fraud models update, settlement systems modernize. In some countries, instant payments become standard. Cross-border transfer gets cheaper. Financial access expands, not perfectly, not everywhere, but measurably. This is not utopia, but it is progress in a domain that used to evolve at the speed of paperwork. And as fintech matures, the big question shifts again. At first, the question is, can a startup build a better interface? Then it becomes, who funds these businesses, who controls the risk, and who decides which visions scale? Because moving money smoothly is one kind of power. Allocating capital is another. PayPal and Stripe show what happens when financial plumbing is treated as a software problem. Interfaces get cleaner, onboarding gets faster, and whole categories of services become accessible to people who never would have walked into a bank and asked. But the deeper game, the one that shapes which technologies dominate and which companies survive, is played by capital allocators, the funds, institutions, and personalities who decide what gets financed, for how long, and under what narrative. Next time, we will step into that layer. We'll meet the new faces of capital, from thematic investors who turn big stories into ETFs, to sovereign wealth funds deploying national savings across the globe, to retail waves that can move markets from a phone screen. If this episode was about turning code into cash flow, The next will be about the people who decide where that cash flows go and how today's markets are increasingly shaped by the stories they are willing to back.